Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. Welcome back to the studio here in the GW School of Business right here in Washington, D.C. This is a GW Investment Institute show. Remember, this is for entertainment purposes only and educational, not investment advice. Today, we're going to cover a company that many people know and use their product every day called Coca-Cola. The ticker is KO. And thanks for everybody for tuning in. If you're watching on YouTube and if you're listening on Spotify, Apple, Amazon, thank you very much. If you're new to the show, welcome and welcome back if you're coming back. And so we're going to go over this company using the GW Investment Institute framework that all of our students use, the business, the management, the price valuation, the balance sheet on our fundamental analysis companies, on our quant funds. Our student work with different models for that. But today it's going to be a fundamental analysis. We're going to use the business, the management, the price valuation, the balance sheet, as we mentioned, the BMPB framework that's been so helpful for us to analyze companies over the 20-year history for the GW Investment Institute. And today, we're going to go over Coca-Cola. So what's the setup for Coca-Cola? So I think everybody knows their products, but this is an enormous company. It has a strong brand, obviously global distribution. A lot of the sales are international, and so obviously people are going to be concerned about that possibly at the moment. But this is an excellent business, and it has been a stable business that has good margins. And, we're going to jump into this. So let's first just talk about the business. Coca-Cola has a very strong brand, right? I think many people and almost anywhere in the world knows Coca-Cola. Now, they may not know all the brands that is owned by Coca-Cola and all the things that they have bought over time, but certainly they know the headline brands like Coke and Diet Coke and now Coke Zero, Diet Sprite as an example, right? So many people know, okay, this is a soft drink company, soft drink company. And they identify it with, certainly those key brands. And they have, they do the sponsorships. And so they certainly know something about sales and advertising as well. So, but let's talk about that business. So this business, you're really trying to sell, obviously, and grow at least as much as GDP. And when you have a global distribution empire like Coca-Cola, sometimes it's very challenging to continue to grow at the same scale. And so when you talk about the business, you have a good business, but you cannot very much, continue to grow at the same rates as they did in the past. So let's start to break it down on the size of the company to begin with. So right now, beginning of May here, you are, early May, talking about Coca-Cola, and this company's market cap right now is $307 billion. So this is not the largest company in the world. This is not a tech company. This is not Berkshire Hathaway as an example, but this is a very large company, $307 billion market cap. What else is important? So let's dive into some of the financials on the business side, just so we get a sense of how big Coca-Cola is and what some of the growth rates have been on the business side. So when we talk about revenue, the trailing 12 months through March, again, we're in early May, but through March, you're talking about $46 billion in revenue and growing at just under 2%. And in the past few years, you've had stronger growth numbers. You've had really big growth numbers in 2021, for example, 17%, 22, 11%, 6% then in 23, and then and then 24 for the full year, 24, you're at 2.4. So you've really seen a decline in that growth rate. And now you're really sitting at kind of 2% for the trailing 12 months and projecting about 2.5% for the full year 25. And analyst estimates have it around 5% for the full year 26. And so, again, you've had this decline in growth on the business side. Part of that, as we were just talking about, these are enormous numbers. When you're talking about, revenue of $46 billion, it obviously is going to be challenging to grow that number. Now, what are some of the good things about this business? We talked about the excellent brand name, and that's highly identifiable. But now let's talk about the gross margins. So the gross margins here, I slipped up and said software, but you would think with these gross margins, it could be a software type of company because your gross margins are 61%. And that's been pretty consistent. You're at 60, then 57, 59. 60 going back over the last few years since 2021. And so these are very high gross margins. Now, that doesn't translate into exactly the same thing on the net side as big software companies. And again, this is a soft drink company. But you have net income margins of 26% for the last trailing 12 months through March for the latest data available 2025. But going back, very consistent in there. So this is an excellent business. So when you talk about, okay, how do we evaluate this business? So let's look at the gross margins, look at the net margin, let's look at the brand. These are excellent. Now, the only, sort of ding that you would have here, the only thing you would say is, well, concerned about this area is on that growth side. And part of that is, well, people don't drink, if they drink one Coca-Cola a day or a week or a month or whatever it happens to be, they don't tend to go from 1 to 10, right? They're not, the same people are not going to continue to consume more and more. So it is a challenge. So they have to think about, are we going to acquire other brands? How are we going to grow? Are we going to get into different businesses? And so that is something that, for example, a competitor, PepsiCo, has got into the snack food business, and Coca-Cola has not really done anything of the same sort. So they've really been growing in the core business, which is the software and the soft drink business, not software, soft drink business, and has been continued to grow there and has been more, I wouldn't say a pure play there, because they're in a variety of different types of drinks, and depending on how you want to say that, including energy drinks as an example, but really have been taking a different strategy than PepsiCo as a big competitor. And many people understand PepsiCo and Coke are competitors on the top line, but certainly when you talk about the snack portion of PepsiCo, very different than Coke. All right, so those are big numbers. Again, just to review to make sure we're on the same page, on the business side, we have the great brand. We have the gross margins at 60+%. We have the net margins at 26%. They have been consistent over the last 5 years that it's great. The concern that we have on the business side now is, well, look, this is a problem on this growth rate, and we're going to have to really try to figure out how do we grow that. And part of what's been happening over this past year is that they're investing, they're deploying cash. The free cash flow in the past has been quite good. When you talk about what is it in 21, and again, looking at it over time. In 2021, full year, calendar year, is 11 billion, and then 22, you're talking 9.5 billion, and then 9.7 billion, and 4.7 has declined in 24. But part of that is the capex. They've been putting more money over time into the business. So when you talk about the capex, that capex has gone up considerably, and the cash flow from operations has come down as well in some of those years. And so it's a mix here. And so that's something we have to pay attention to. They're certainly trying to invest a little bit more in the business the last couple years. They have dialed that up from 1.3 billion on the capex side, 1.4, 1.8, 2 billion, and 2 billion for 24, and now the trailing 12 months, and it's probably going to be about 2 billion for the full year 25. But part of that is that the cash flow for operations has come down. And so that is something that we are going to be watching and concerned about. We're shareholders of Coca-Cola, and so generally that has been good. But again, something that we have to pay attention to, something that we have to be concerned about, and something that we need to stay focused on the business side. But this has been a great brand over time. This has been a long-term hold for Berkshire Hathaway, which we recently talked about, and Warren Buffett has been a huge fan of Coca-Cola. And if you looked at if you attended the annual meeting or you watched it online, you see that Buffett had both a regular Coke and a cherry Coke directly in front of him for the Q&A portion of that meeting. And so certainly always advertising for the company. Always, has been a long-term shareholder in this company. He talked about that a couple letters ago as well in the Berkshire Hathaway annual letter. So now that's the business side. And we're going to pull it all together here at the end, the business, the management, the price, valuation, the balance sheet, and we'll score each one of those things. But let's talk about the company first a little bit. So now let's move on, to management. Management, has been excellent. Obviously there's been different people over time. James Quincy now is the chairman and CEO of the company. Coca-Cola has been very stable over time. You have not seen, maybe some people, and he's been there 6 years now. If people think back to pre-COVID, if you think back to one of the major blunders of possibly all time is the new Coke story that happened. And that's obviously way long ago, and many younger people that are watching or listening might not even know what that is. But certainly haven't had a big blunder like that for quite a long time. One of the things that I think continues to be a concern on the management's agenda is the health piece. People trying to be healthier. The amount of sugar that's in Coca-Cola and all of the other drinks as well is a big concern for consumers. And so if people want to be healthier and they want to access their drinks, are they offering different products? And they have been. And they've been trying to offer healthier things as well. But certainly there's still high demand for the things that are not quite as healthy and positioning that. So I think that management's doing a reasonably good job. They've been growing the company. They've been keeping those margins high. And I think that the leadership at the company has gone through these, sometimes I would call these potentially difficult times to navigate through. Well, lots of people are concerned about, diabetes as an example, and the amount of sugar that's in these drinks. And so how do you navigate that? How do you provide the product to the consumer that wants that, but it also be responsible on the public health side of that equation? And so I think they've navigated those waters relatively well. I don't think any management team is going to be perfect. But when you talk about the capital allocation side, I think they've been very responsible. The dividend yield right now sits at 2.86%. So relatively positive dividend yield. They've been growing that very responsibly over the last 5 years at 4%. So I think you have to give fairly good grades. And on the acquisition side, have been responsible about going out and getting different brands. And, these things are challenging. You have to figure out, what's going to be, let's say, interesting, what's going to be potentially a fad, and distinguish what are those two things, and make sure you're not overpaying for what's potentially a fad and something that is going to be transformational and is actually going to add to your portfolio of drinks. And so that's not easy to do because some of these things can be faddish, for example. So again, on the capital allocation side, I think that you give the growth piece a fairly good score. You give certainly the capital allocation on giving money back to shareholders on the dividend side, 2.86%, and having that growing at 4%, very responsible there. And we're going to come back and talk about scoring here in a moment, but let's move on now to the price valuation, for example. And so when you look at what's the current multiple on Coca-Cola? You're talking about 24 times is the forward PE right now. And again, this is early May. This is not necessarily high or low. So when you talk about, what's the historical 10-year number for Coca-Cola? The median is around 23 times. So we're not especially pricey right here. This has not been something where you're like, this is really high. They've traded as high in the last 10-year period up to almost 30 times and as low as 19 times. So you're really not high or low, very much on the average PE right now for Coca-Cola. And so it's not something that you're going to necessarily get super excited about as you're getting a great deal, or be too concerned that you're overpaying if you're acquiring shares right now. We're current shareholders of Coca-Cola. We've been long-term shareholders at the Investment Institute. We'll continue to be at the moment. So I think it's important to think about the valuation here, but it's not necessarily something that's going to be a determinant and making a decision. It's not so overvalued. It's say, look, this thing has gone crazy. It's trading. If it was trading at 35 times beyond the 10-year, high number, maybe we would be concerned. And if it was trading, below 19 times, maybe we should be thinking about acquiring more shares. Now, if it's trading below 19 times, maybe there's something wrong with the business, and we'd have to consider that. But right now, you're really talking about you're trading on the average or the median for the last 10 years. And so you probably give this score somewhere between a 5 and a 7, and we'll get to that. So this is not, again, dramatically overpriced or underpriced, but that's where the 10-year numbers are. So we're not terribly concerned about that. Now, when we talk about the balance sheet, this is where we probably have a lower score, and we'll talk about that. But they have $13 billion in cash approximately at the end of March, and nearly $50 billion, $49 billion in debt. And so this is obviously a net debt situation, significant numbers. but they're generating free cash flow in the past. This year, not yet through the March numbers, but expected for the full year to generate 5.8 billion for the full year of March. Through the full year 2025, and 4.7 last year. So not necessarily concerned about that on the debt side. And so that doesn't make us sleep better at night. And certainly it's not the case. We were talking about Berkshire Hathaway with over 300 billion in cash. And so that helps us really sleep well at night. And one of the ratios that we encourage all of our analysts to look at, and you should be looking at as an analyst, as a business person, when you're looking at the balance sheet, if it is in fact a net debt situation, is the interest coverage ratio. In this case, Coca-Cola is at 6 times. That is not a great number. And so this is where we would definitely give the balance sheet a little bit of a lower score. At 6 times, it's not exciting for us. It's not something we're gonna lose a lot of sleep about, given the stability of Coca-Cola's business, given the global brand, all the things we mentioned about how great of a business it is. But again, not something that we would prefer. And I think if we had a chance to talk to the management team, we would probably tell them that, is there a way to improve this metric, obviously without putting any, detriments to the growth of the business, but how do we be more responsible? Getting this in the 10 times would probably be preferable. Net cash doesn't necessarily have to be for this type of business because it is a high cash flow business. And so, but I think we would all sleep a little bit better if they get closer to 10 times on this interest coverage ratio, and that's EBIT over interest. And so that's earnings before interest and tax over the interest expense. It's currently 6 times, and not alarming, but not helping us sleep better at night. Again, if we were talking to management, we would say, hey, let's get this closer to 10 times. And so again, balance sheet probably going to get an average score. So now let's go to start talking about all of these components together. And so when we talk about the business, again, this is a strong brand, obviously historic brand, global reach, excellent margins as we talked about. The 60 plus percent gross margins and the net margins in the 20s here. There is pressure here when we talk about from competitors, right? You certainly have people like PepsiCo as obviously one of the most direct competitors. And people have choices, and certainly when people really feel pressure, they trade down to possibly even store brands and private label as an example. But excellent, excellent return on equity numbers here at 40%. And the revenue growth has been excellent over the last 5 years, but let's say good but not excellent at roughly 7% average, let's say. So the business is good but not necessarily great. When we look at the numbers for the gross and the net margins and the return on equity, those are excellent. But when you look at the growth in that revenue, that probably has been average. And again, you're talking 2% from the prior year. So it's not really a tremendous growth. And so probably going to give this business, you're going to give the high sort of scores to the components on the gross and net margins, and then you're going to ding it on the revenue growth side. So you're probably talking about a 7. Then you talk about efficient capital allocation, the dividends, the acquisitions, very strong track record. Again, that's why you got this return on equity, which is such a good number in the 40s. They have aligned incentives, and they have done a reasonable good job here. Again, they've been growing that dividend 4% very responsibly, to pick out one piece of that capital allocation. So they've been doing a good job there. Maybe not the best job, and so maybe it doesn't deserve a 9, but you're certainly thinking here in the neighborhood of 7. On the valuation side, this would be very much average. We talked about it's trading right on top of the 10-year average, 10-year median number here. So you're not necessarily going to get too excited about that. The earnings yield, to use a metric from Joel Greenblatt, 4.8%. So this suggests a modest overvaluation if you're using that number, but not, if you're using the PE and you're looking at the 10-year time horizon, you're probably going to give it a modest score. So probably something closer to like a 6 here. It is on the higher end, but it's certainly not near the all-time highs, and it's really average with respect to its own 10-year number, and it's pretty much slightly higher than the S&P 500. On the balance sheet side, I would say you're going to give it a ding here. The credit rating's still good though, at an A+, but the 6 times interest coverage ratio is a concern. Not something that we would like to have at 6 times. Rather have that interest coverage closer to 10 times to help us sleep at night. But, they have great cash flow. Again, this is a cash flow business, but so you're probably going to give the balance sheet, between the 6 and the 7. So depending on how you total all those up, you're going to weight those at 25% each. That's going to give you somewhere in the neighborhood of, a 7, let's say, for that score. And maybe it's between a 6 and a 7 if you're really harsh on some of these scores. But let's call it a 7 if you massage all the scores appropriately. So good, not great. This is a company that we own in the portfolio, so we're going to continue to watch this company. And again, this is a great business. This is a good management team. The valuation is probably average. The balance sheet is, something that is okay, but, something that we have to watch. So Coca-Cola has been a longer-term hold in our portfolios at the GW Investment Institute. Like Buffett, not as long-term as Berkshire Hathaway and Buffett. But it is something that I do think that we're going to have to watch. And so we've wrapped up for this semester. So for the fall, we're going to be asking our analysts, make sure we take a good look at Coca-Cola. It's been an excellent hold in our portfolio. Again, has this strong brand, has this recognition, has these gross margins, has these good net margins, has good return on equity. They have been effective capital allocators, good dividend yield, price valuation, okay, balance sheet, okay. So I think it's up to us to try to figure that out. And if you're paying attention to this company, it's something as an analyst, as a business person, as an investor that you're going to need to think about. Many people love Coca-Cola, but what's going to happen from here? What are the acquisitions that they're going to do? What's the capital allocation? What is the growth strategy? Where's the revenue coming from? We didn't get deep into that, but a lot of it's international. That's something to think about and tackle. But that'll be for another episode. So thank you. Remember, this is entertainment and educational advice only. But that's a wrap for Coca-Cola and this episode of Market News with Rodney Lake. See you on the next episode. Thank you. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.